Assalamu alaikum everybody, hope you are doing well. So in today's class I'm going to discuss one complete question of March 2025 exam series, and this is A-level economics paper 4, right, under the Cambridge stream. This was a question of section C, and it was question number 4, and the question says, you can stop the video and read the question carefully, and you can try to make like mind map for the answer. Then you can play the video and see how to answer this question actually. So with the help of a diagram, assess the effectiveness of government policies that might be used to reduce demand pull inflation. So this was a 20 marker question. And like how to answer this question, as I told you earlier, you can stop the video, you can make some points for this question, and then you can play the video again and see what is the best possible answer to this question. Okay, so if you try to make mind map for this question, you can do that. Like you can, like, center point is question number 4. And we have to answer each 20 mark question by considering 3 assessment objectives. Assessment objective 1, AO1, is assessment objective 1 that shows knowledge and understanding, right? And then we have another objective, and that objective is assessment objective 2, and this is known as analysis, right? And the other and last objective is assessment objective 3, and assessment objective 3 is evaluation, right? Evaluation. So how to answer this question then perfectly? So first of all, keep in mind for assessment objective 1, we have to pick the important terms given in the statement of question, and if there is any statement or any like kind of economic term that can be helpful to answer this question, you have to explain that statement as well. So assessment objective 1 and assessment objective 2 collectively have 14 marks, and you can like divide them into 7 marks for assessment objective 1 and 7 marks for assessment objective 2. But examiner gives you a little liberty here. Examiner like expects from you to write a thorough answer for assessment objective 1 and 2 that can cover total 14 marks. Sometimes students write more about assessment objective 1 and less about assessment objective 2. So examiner allows you to do that, and you can still get full marks, like 14 out of 14 marks. And sometimes students have more analysis. They can analyze the situation well, and they can't give a lot of knowledge about the question. Then examiner still gives you full marks if you give more analysis and less assessment objective 1 or knowledge and understanding. So you can like you need not to basically give answer that is equally balanced between assessment objective 1 and assessment objective 2. So it's up to you, you can balance them, right? So a very good and standard answer may explain assessment objective 1 on 1 page. There should be 1 complete page for assessment objective 1, and there should be 1 complete page for assessment objective 2, and 1 complete page for assessment objective 3. This is the minimum like required length that will cover everything that is required by the examiner. And then what is assessment objective 3? Assessment objective 3 is evaluation. So this also like contains 6 marks, so 7, 7 and 6 marks, right? Collectively assessment objective 1 and 2 have 14 marks. These two objectives have collectively 14 marks. So what to write in assessment objective 1? You have to pick the important terms given in the statement of question and explain them. For example, the important term here is inflation. So first of all, you have to define what inflation is. So define inflation, right? So inflation is the persistent rise in general price level over time. So this is the basic definition of inflation. Then you have to explain what demand pull inflation is, right? So second thing is demand pull inflation. So you will say that demand pull inflation is a type of inflation which is caused by rise in aggregate demand in the economy, right? So whenever there is rise in aggregate demand in the economy, that will cause demand pull inflation. Keep in mind, sometimes students like just write rise in demand causes inflation. That is not correct. You have to write that rise in aggregate demand will rise demand pull inflation or cause demand pull inflation. So you have to use aggregate demand instead of just demand, right? Demand is a microeconomic issue and aggregate demand is a macroeconomic issue, macro, M-A-C-R-O. When you are explaining macro related concept, then you have to use aggregate demand and aggregate supply, and in micro you can use demand and supply. So this is the situation of macroeconomics, right? So use aggregate demand and aggregate supply. So demand pull inflation is caused when there is increase in aggregate demand, while aggregate demand may rise due to rise in any of the following components. Aggregate demand is the sum of consumption plus investment plus government expenditure plus exports minus imports, right? So X minus M is net exports or exports minus imports. So why aggregate demand increases and why inflation is caused? So these are the important components that you have to keep in mind. So whenever there is rise in consumption, as per the basic math rule, if there is rise in right hand side, then left hand side will automatically increase. And similarly, rise in investment, I stands for investment. If there is rise in investment, again this will cause rise in aggregate demand. Rise in government expenditure and rise in net exports will also cause rise in aggregate demand in the economy, right? So whenever there is rise in aggregate demand in the economy, it will cause demand pull inflation, right? While you are explaining this point, you can make the diagram as well. So what will be the diagram for that? So I'm making that diagram here, and you can see this diagram. It will look like this. So this is aggregate demand, which is negatively sloped. So you can make aggregate demand curve like a straight line, or it can be a little curved as well. So it's up to you. Examiner accepts both the concepts. So on X we have real GDP. Also keep in mind, some students like write quantity here. That is totally inappropriate while we are talking about macroeconomic situation. So you have to write strictly, you have to write real GDP here. You can't write quantity here. And this is demand, like rather aggregate demand, and this is aggregate supply. On Y we have price level. Again keep in mind, this is also really important thing to know, that you can't write just price here. You have to write price level or average price here. Again, this is the issue of micro and macroeconomics. So when we are discussing anything related to macroeconomics, so we write price level or average price, and when we talk about individual microeconomic issue, then we just write price here. Equilibrium in the macroeconomy will take place at E, where the real GDP is Y and price level is P. So we use the word price level here. Okay, so whenever there is rise in aggregate demand, as a basic principle of economics, we know that aggregate demand should shift to the right? So rise in aggregate demand will shift aggregate demand curve from AD to AD1. Equilibrium will move from E to E1, where real GDP will increase from Y to Y1, but at the same time price level will increase from P to P1, right? So this rise in price level from P to P1 is demand pull inflation, right? So this is demand pull inflation. So we have like seen how to make the diagram, and then you have to like write explanation of this diagram as well. If you are struggling with explanation most of the time, then I'm just writing it for you so that you understand how to like write explanation of the graph. So this is like really simple stuff, and whatever I was saying, you have to write exactly the same thing here. So let me write it for you so that you understand it well and you can reproduce it in your exam, right? Since exams are about to reach and you are really like concerned about that and making a lot of effort for that. So you can say that as per this figure, as per this figure, an initial equilibrium in macroeconomy is taking place at E, where the price level is P and real GDP is Y. So we use Y for national income, or sometimes we use Y for income as well, as you have like studied already income elasticity of demand in AS, and for income we use income elasticity of demand, we use YED. So Y represents income, right? So is it compulsory to use Y? So it is better to use Y as an income or GDP or national income. Otherwise you can use some other variable and you can define that variable in your explanation, telling the examiner that you are writing that variable for national income. But it is more appropriate if you write directly Y here. So Y stands for the yield, or it is also alternative for the income, right? So for yield we use Y, and Y shows national income or real GDP. Okay, so now moving to the next thing, the rise in aggregate demand shifted demand curve to E1, where the price level rose to P1 and real GDP rose to Y1, right? And the rise in price level, or this rise in price level, is demand pull inflation. Demand pull inflation, since it is increasing because of increase in aggregate demand, right? So this is the explanation to this diagram. Okay, so then like moving to the next thing that you have to write in the knowledge part. So right now I'm discussing the knowledge part right now, right? So what else you can write in the knowledge part? In the knowledge part you can like identify the government policies that can be used to like correct demand pull inflation or reduce demand pull inflation. So what are those policies? The two policies that can be like used here include like fiscal policy, and the second policy is monetary policy. You can just like define them. Fiscal policy is the policy of central bank government of the country that manipulates direct taxes and government expenditure to affect aggregate demand in the economy, while monetary policy is made by a central bank of the country that manipulates money supply, interest rate and exchange rate to influence like aggregate demand in the economy, right? So you can mention these basic definitions of two policies. And now moving to the analysis part. So you are done with the first part. If you do all this, whatever I have told you, then it will lead to 7 marks in your pocket. Moving to analysis part, now you have to actually answer the question. The question is the effectiveness of demand side policies or government policies that can be used to reduce demand pull inflation. So now you will start answering the question. Analysis is basically connecting the variables given in the question, right? Connecting them and creating relationship. So you will have to now explain how government policies can correct demand pull inflation. So you will say that number one is like fiscal policy. Fiscal policy will increase direct tax. Keep in mind this is direct tax, that include like income tax, and government will decrease government expenditure. When tax rate increases, consumers will consume less, and if government expenditure also decrease, then overall aggregate demand will fall in the economy. So aggregate demand will decrease because we know that aggregate demand is the sum of consumption, investment, government expenditure and net exports. X minus M is net exports. So if government expenditure is decreasing and due to high taxes consumption is decreasing and investors are unable to invest more, so overall aggregate demand will decrease and demand pull inflation is controlled. You can make another graph showing like leftward shift in the aggregate demand curve, or you can exactly refer to the same graph that you have already made. So you can name it as figure 1. Here you can say that as per figure 1, when government uses contractionary fiscal policy, that is government increases tax and decreases government expenditure, and this policy will lead to decrease in aggregate demand, and aggregate demand will shift back from AD1 to AD, and equilibrium will move from E1 to E. So at E1 price level was P1, and now due to decrease in aggregate demand, equilibrium will move to E and price level will decrease to P. So now you can see there will be decrease in price, and decrease in price is known as like controlling inflation, right? So another important thing or policy that you can explain here is monetary policy, right? So monetary policy is the policy of central bank of the country that manipulates interest rate, right? You can, like, you need not to explain every tool of the monetary policy. You can just pick any one or two of them and explain that as an analysis part, right? So that would be sufficient to like get 7 marks if you explain fiscal and monetary policies, 2 tools of fiscal policy and at least 1 or 2 tools of monetary policy. Then you will also get 7 marks here as well. So monetary policy increases rate of interest. I'm using R for rate of interest. When rate of interest increases, consumption will fall, investment will also fall. I'm using I for investment, C for consumption. And when consumption and investment both fall, aggregate demand will decrease. And when aggregate demand decreases, again demand pull inflation is controlled. So if you explain only one component of monetary policy, that is also sufficient. But if you have good like pace and you can write more, then you should explain one more point as well. Like credit regulation is another like tool that monetary policy uses to control aggregate demand in the economy. Open market operations, exchange rate, money supply, these are the different tools. Right now, if I say that credit regulation is another tool that monetary policy may use, and credit regulation, what credit regulation does is, credit regulation refers to the rules and regulations that are followed while getting loans from the financial institutions. Right? If credit regulations are tough, it means it is difficult for the people to get loans from the financial institutions like banks. And when they are unable to get bank loan, then they will spend less as well. Investors will invest less as well. So again, aggregate demand will fall and demand pull inflation will be controlled. Now moving to the other important thing, and that is the last part of this question, and that is known as evaluation, right? So in evaluation part, what we do is we have to write down limitations of these two policies like fiscal policy and monetary policy. So we will identify the problems or limitations of these policies. You can say that if government uses fiscal policy, I'm using FP for fiscal policy. Through fiscal policy, if government increases tax rate, direct tax rate, and decreases government expenditure, that will decrease aggregate demand in the economy. And when aggregate demand falls, it will control inflation, but at the same time it will like decrease economic growth in the country. So GDP will decrease from Y1 to Y. It will move back. So this is like the limitation or problem caused by contractionary fiscal policy. It is also known as like expenditure dampening policy, that is decreasing aggregate demand and aggregate expenditure, so it will decrease real GDP in the country as well. So the problem is like growth in the long run will fall, growth will fall, and unemployment may also rise, because unemployment, this is unemployment will rise because economic activity is decreasing due to lower aggregate demand. So in the long run it will be harmful to the economy. Same thing happens with the monetary policy. Monetary policy is also contractionary, and contractionary monetary policy is also like expenditure dampening or expenditure reducing policy that reduces overall expenditure in the economy and decreases aggregate demand. So when aggregate demand decreases, again it will harm the economy in the long run in the form of like lower employment opportunities, lower GDP of the country, and sometimes crime rate may also increase, because if people don't get jobs and economic activity is low, then definitely they may be involved in criminal activities. And still, this is not the end of the answer. You have to sum up your discussion in the conclusion part, where you will like recommend finally the effectiveness of these policies, the extent to which these policies can be effective. So in conclusion, you can say that conclusively, fiscal and monetary policies are no doubt very good tools to control demand pull inflation in the economy in the short run, and they are like relatively quicker than supply side policy. Although monetary policy also takes a little more time, like 1.5 years to bring an impact on an economy. Yeah, fiscal policy is, however, very much quick as compared to the monetary policy to influence economic indicators in the country. But these policies are much faster than the supply side policy, right? So you can say that although fiscal and monetary policies are good policies to control demand pull inflation in the economy, however, these policies will harm the economy in multiple ways in the long run period of time, such as lower economic activity, high unemployment rate, and lower economic growth. So these are the drawbacks of this like policy as well. And this is the complete answer to this question. So hope you understand that, and if you understand, then just thumb up and subscribe to this channel as well. And if you want to attend my classes online, then you can contact me at +92 333 44 29673, right? So this is my number, and you can get it from here, and WhatsApp me if you are interested to join my classes. So hope you understand it. See you in the next lesson, inshallah. Thank you.